School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 4 Financial Statement Analysis, Unit 13 Comparative, Common Size and Trend Statements, Part 1.
After completing this unit, you should be able to understand the meaning and rationale of ratio analysis, provide a broad classification of ratios, identify ratios which are appropriate for control of particular activity, and discuss and interpret various ratios. Introduction. The financial information relating to any business firm is included in three fundamental financial statements: the balance sheet, income statement or profit and loss account, and cash flow statement. The balance sheet focuses on the resources or assets that are at the firm's disposal and the obligations or liabilities of the business firm. It is thus a statement of what the firm owns and what the firm owes as on a particular date. The balance sheet is a snapshot of the assets and liabilities of the firm at a point in time. The income statement summarizes the revenues earned, the expenses incurred to earn those revenues, and finally the profits generated or losses incurred during an accounting year. The profit is the surplus of revenues over the expenses incurred. It thus depicts the profitability position of a firm during an accounting period. The third financial statement prepared is the cash flow statement, which reflects the sources and uses of cash or the flow of cash during an accounting period. It is also called the statement of changes in financial position. These financial statements summarize the transactions carried by a business enterprise over an accounting period in financial terms. These financial statements need to be analyzed to gain better insights into the strengths and weaknesses of the firm. Such an analysis is undertaken by establishing relationships between different items of the balance sheet, income statement, and cash flow statement. Besides the management, other stakeholders interested in such an analysis are the shareholders, prospective investors, creditors, customers, suppliers, lenders, and the government. Shareholders and the prospective investor want to know if the money they have invested or intend to invest would grow in value over a period of time or not. Creditors who have lent funds want to know if the money they have lent to the firm is safe or not. Even employees who work for the firm want to know if the company is profitable or not, so that they receive the compensation and other benefits regularly. The government also wants to know if the firm would be able to pay taxes or not. One of the ways to find answers to such concerns is by conducting a ratio analysis. Ratio analysis. Ratio analysis is an important tool used in the analysis of financial statements. A ratio is simply the relationship between any two or more things. In the context of financial statements, when any two or more items of the financial statements are expressed as a ratio, it is called a financial ratio. We can comment on the performance of a student only when the marks obtained by him are seen in conjunction with the maximum marks. Similarly, to evaluate the performance of a firm, say in terms of its profits, just knowing the quantum of profits earned by the firm is not enough. We can comment on the performance only when the profits are compared with either the investment made or the sales. Types of ratios. Any business has many stakeholders. Different stakeholders in a business firm want to evaluate the financial performance of firms from their perspective. Shareholders or the owners want to evaluate if the business enterprise is profitable and financially strong or not. They want to know if the money invested by them has grown over the years or has the investment eroded. Short-term creditors and suppliers of raw materials want to know if the company would be able to repay the short-term credit which they have provided. They are therefore interested in knowing about the short-term liquidity position of the firm. Similarly, lenders of long-term finance are interested in the long-term solvency and profitability of the firm. Management is interested in the overall performance of the firm. Thus, each stakeholder wants to examine and evaluate the financial statements from their perspective. Thus, we may categorize the financial ratios in different categories. They are profitability ratios, liquidity ratios, leverage ratios, coverage ratios, efficiency ratios, and valuation ratios. As the name suggests, the profitability ratios assess the firm on its profit earning capacity. The liquidity ratio measures the firm's ability to meet its short-term liabilities. Leverage ratios analyze the proportion of debt and equity in the firm's capital structure. The valuation ratios are used to value the investment made by the shareholders. Profitability ratios. Profit is the surplus of the revenue earned by a firm by selling its products or services over the cost incurred to produce those products or render the services. It is imperative for a firm to earn profits to sustain its operations in the future and reward its shareholders who have invested their funds in the firm. Creditors would also like to see the firm to whom they have provided funds to make profits so that the firm is in a position to repay the loan and pay interest as promised. Employees and workers would want the company to be earning profits so that they receive salary and incentives regularly and on time. A loss-making firm would not be in a position to pay taxes to the government either. Hence, it is important to evaluate the profitability position of a firm. There are various profitability ratios that are usually calculated. Gross profit margin or gross margin is the ratio of gross profit earned during a year to the sales of the firm during the same period. This ratio indicates the gross profit earned by the firm on every rupee of sales. Hence, is indicative of the efficiency with which the firm produces each unit of output. Gross profit is defined as the difference between the sales revenue or net of taxes, GST and sales return and the cost of goods sold. Hence, the equation is gross profit margin equals to sales minus cost of goods sold, which is equal to gross profit divided by sales revenue. Gross profit margin assesses the efficiency with which the firm produces its products. A higher gross profit margin implies that the firm is able to generate better price for its output, produce goods at relatively lower cost, or both. If the gross profit margin is low, it indicates that the firm produces its product inefficiently. The management would need to investigate its sales policy and marketing efforts, purchasing policy, or producing goods more efficiently. Net profit margin or net margin relates net profits to the sales of the firm. Net profit or profit after taxes is calculated after deducting operating expenses, interest on capital, and taxes paid to the government from the gross profit. It relates the profit after taxes to the sales revenue. Hence, the equation is net profit margin equals to profit after taxes or net profit divided by sales revenue. Like the gross profit margin, the net profit margin also indicates the overall efficiency of the management from producing the goods to selling them. Both the gross profit margin and net profit margin need to be evaluated in combination with each other. Consider a situation where although the gross margin has been increasing over the years, the net profit margin is not increasing at the same rate. This might indicate that although the efficiency of the firm in manufacturing the goods is improving, its operating expenses or interest expenses are increasing, which is suppressing the net margin. Hence, each expense head needs to be examined to find the causes of the falling trend in the performance. No PAT margin relates the operating profits to the sales of the firm. Net profit margin is calculated by relating the profit after taxes to the sales revenue. In calculating the profit after taxes, interest on long-term debt is deducted. Hence, two firms, although similar in their operations but differ in their capital structure and their net profit margin, would not be comparable. Therefore, a better measure of profit that omits the effect of financial leverage is the net operating profit after taxes, that is, no PAT, computed as EBIT, that is, 1 minus tax rate. So, the no PAT margin is computed by relating no PAT with sales. Hence, the equation would be net operating profit margin equals to no PAT or EBIT, that is 1 minus tax rate divided by sales revenue. EBITDA margin relates the earnings before interest, taxes, depreciation and amortization, that is EBITDA, to the sales of the firm. As mentioned earlier, EBITDA is a broader measure of profits. It is usually considered as a proxy estimate of the cash profits from the operations, as it excludes interest, taxes, and even depreciation and other non-cash items. EBITDA measures the operating profits of the firm. As EBITDA excludes interest, taxes, and depreciation, it is not affected by differences in capital structure, depreciation policy, and impact of taxes due to these differences, which makes the comparison more effective. Hence, the equation becomes EBITDA margin equals to EBITDA divided by sales revenue. So far, we have compared different measures of profits, that is, gross profit, net profit, operating profit, and EBITDA with sales revenue of the firm. Profits may also be compared with the investment made by the different suppliers of funds, that is, equity shareholders and debt holders. Return on assets or ROA relates the no PAT with the total assets. No PAT, as defined earlier, is EBIT into 1 minus tax rate, while the total assets are the aggregate of current and non-current assets. Hence, the equation becomes return on assets or ROA equals to no PAT or EBIT into 1 minus tax rate divided by total assets. Total assets EBITDA is a wider measure of profits and is usually considered as a proxy estimate of the cash profits from the operations, as it excludes interest, taxes, and even depreciation and other non-cash items. Return on capital employed, that is ROCE, relates no PAT with the amount of funds, that is both debt and equity. Hence, the equation becomes return on capital employed or ROCE equals to no PAT or EBIT into 1 minus tax rate divided by total debt plus shareholders' funds. ROCE may also be calculated on a pre-tax basis as return on capital employed ROCE equals to EBIT divided by total debt plus shareholders' funds. Return on equity or ROE relates the profit after taxes with the funds provided by shareholders. Return on equity ROE hence is equal to profit after taxes or PAT divided by shareholders' funds. The shareholders' funds or net worth consist of paid up equity capital and reserves and surplus or net of accumulated losses if any. Paid up equity capital is the funds that has been invested by the equity shareholders, while reserves and surpluses are the retained earnings that belong to the equity shareholders. Equity shareholders are entitled to profits after paying all other stakeholders, that is, profits after taxes or the residual profits. Hence, PAT is related to the funds brought in or that belong to the equity shareholders. ROE indicates how well the firm has deployed the resources provided by the shareholders and is an essential financial ratio calculated by equity analysts. Earning per share or EPS indicates the earnings of the firm on a per share basis. It is calculated by dividing the profit after taxes by the number of equity shares outstanding. Hence, the equation becomes earnings per share or EPS equals to profit after taxes divided by number of equity shares outstanding. EPS reflects the amount that the company has earned in a year on each share. However, the shareholders do not receive the entire earnings. They receive only a part of the earnings, which is called the dividends. Hence, another ratio calculated is the dividends per share. Dividends per share or DPS indicates the dividends of the firm on a per share basis. It is calculated by dividing total dividends paid by the number of equity shares outstanding. So the equation becomes dividends per share or DPS equals to total dividends divided by number of equity shares outstanding. Dividend payout ratio indicates what percentage of the earnings are paid out to the shareholders as dividends. Hence, it is calculated by dividing dividends per share with earnings per share or the total dividends by profit after taxes. So, the equation becomes dividend payout ratio equals to total dividends divided by profit after taxes or dividends per share divided by earnings per share. Dividends are the returns which an investor receives when he buys shares of the firm. From the perspective of an investor or a prospective investor, it would be important to evaluate how the returns, that is dividends, compare with the investment, that is the market price, made by him in the shares of the firm. Dividend yield relates the dividends per share with the market price of the shares. Hence, the equation becomes dividend yield equals to dividend per share divided by market price per share. It indicates the amount of dividends that the investor would receive per rupee of investment. Similarly, earnings may also be related to the market price to arrive at the earnings yield. Hence, the equation becomes earnings yield equals to earnings per share divided by market price per share.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center, of Indira Gandhi National Open University.